Hello, reader. Oak Bloke here. I want to cover the news from yesterday that broke, which is this year on Digital 9 and the divestment of Aqua Comms for $48 million. So clearly, massive disappointment in terms of the realised value. Obviously, the market reacted very strongly as a result. And for those of you who don't know this news, this was essentially that this company, I Squared Capital (EXA), are buying Aqua Comms, which is a transatlantic um, cables business. It's obviously a number of different things here. So there's some delays and so on, take 12 months to go through and so on. So the equity value is 54, so 28% discount to the 75 million as at June 24. Deducting transaction costs, then net proceeds 48, so a 36% discount, or 2.6 pence a share discount to the value as at 30th of June. So this valuation was the valuation that was in our best interests to not know about. And it goes on to say the valuation at the end of December was 283, and then there was a $208 million write down as at 30th of June, reflecting the inability to fund the Asian growth projects as well as other factors set out below. So let's examine the other factors set out below. So the factors set out are that it repeats itself and says Asian growth projects. So yeah, kind of said that already, but let's okay, second time. Margin compression, overbuild in all markets where, despite rapidly growing demand, build out is outpacing demand, and increasingly compressing margin. This has been driven by hyperscalers and technological improvements that have led to a consistent 15% decline in pricing over the past 5 years. So go back 5 years to all of the annual reports. Where were we told about this consistent decline in pricing? In fact, I mean, that's part of today's, I suppose, session. Let's consider the evidence. So this is the evidence. So this was written 103 days ago, so just 4 months ago. This is the interim report as at 30th of June. And rereading it, it's true to say that it says here that aggregate revenue declined 1% year on year, and EBITDA fell 7% due to continued margin pressure. So they do say continued margin pressure at Arqiva and Aqua Comms. But let's consider the update we were given, which was higher than expected O&M sales, okay, and there was a 7% year-on-year drop in EBITDA in the 6 months, and the portfolio's fair value was reduced. Further details are provided. So the explanation they go on to give us is down here. So just talks about what Aqua Comms is, high-speed solutions for carriers. So it says here, EBITDA decreased 12%, mainly, note the word mainly, because of the planned addition of headcount. So we seem to be told very different things yesterday and 4 months ago. So either they just simply got it wrong 4 months ago, but not just 4 months ago. We're told for 5 years this has been happening. Okay, 5 years this has been happening, and during those 5 years, they've made further investments into capacity. Okay, and in one of my articles, I sort of said, well, look, on the price paid and on the rates back in acquisition 2020, was it 2020 or 2021? I think it was 2021. Based upon the capacity build out at steady rates, this is kind of how the profit theoretically could look, which came up with this theoretical number of 1.23 billion, which I saw somebody use yesterday as reasons why I'm giddy, which clearly was taken massively out of context and wasn't the point at all. But nowhere have we been told about these consistent declining prices. Nowhere have we been told about the intense competition. And it goes back to the key point here. Why were investments being made into something that was clearly not attractive? I mean, the whole premise of this build out was that, by investing into this capacity for the growing demand for and that there was going to be temporary costs. So all of these temporary, mainly headcount building out, and investing in to a certain result. There are certainly questions and inconsistencies between what we're being told yesterday in the RNS and what we were told as recently as 4 months ago. The two don't add up. Now, some readers clearly said, look, the prices are dropping, da 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 da. But that wasn't what was in the report. That wasn't what we were being told. The evidence clearly says build out of capacity to support growth. And, whilst we don't get to see the intimate details of the holding companies, like, why were they making these investments into something that was clearly not didn't have a good rationale? It just didn't have a good rationale. The article goes on to say about the indefinite delay to the project due to ongoing conflicts in the Red Sea, but completion was 3 months ago of the stretch of cable across the Red Sea and into Egypt, and then the rest of it was going to go terrestrially across Egypt and then exit in the Mediterranean, where there is no certainly there is no conflict in the Egypt area as I speak. So again, this indefinite delay. Well, that's not accurate. Perhaps 8 months ago, 9 months ago, when they were looking to sell, it was accurate then. That's true then, but in yesterday's RNS, that simply wasn't the case. So, again, the appreciation that could be realised as part of the combined sale, well, I suppose that ship has sailed, but it's a great pity because obviously what is emerging is that the strategy was very much upon the synergy between the two. So selling them separately was clearly anagistic, that it lost value by selling them separately, and it talks as well about M&A market conditions and it's not a good time to sell, which okay, fair enough, fair enough on that one. But I disagree with this, that there was an indefinite delay. I think that's debatable, and clearly investors have lost out by selling them separately. That's emerged as very, very clear. Yeah, it's very, very disappointing. But look, it is what it is. It's happened, and presumably the contracts are signed, so there's no going back to kind of say, well, hey, actually, you know, we're going to rethink this, sell them together. You know that the M&A market conditions are now improving. Okay, that this I guess the question around margin compression and the future of margins, I guess that's one to think about, of course. But yeah, it is disappointing. But anyway, you know, the ship has sailed. Let's assume that. So kind of coming, you know, what kind of my next thought then was to say, well, what because in this article here and in a video I recorded about this article, I did talk about how there was a lot of value and it was very difficult to see um, how this will how the outcome of this will be it ends up selling, you know, at 20 pence or below, even 25 pence or below. So do I still think that? Obviously this is a setback, but do I still think that? Well, I've worked through the numbers, and that that was the next part to talk about today. So yeah, let's kind of dive into the numbers. So what we see is that the EMIC one has already been so these were the values back in these were the values back in 1H 2024. So that should be a 1, not a 2. So these are the actuals from the interim. Okay. And in that, at the time, we had question marks, and of course, we now know that the Aqua Comms was valued at 75 million, and I've assumed a 1.25 rate there because that kind of was the rate back last June. And we sort of retrospectively also know, because they've shared with us the value of EMIC 1 last June, which was this, which has since sold for this. We worked out, or I worked out, the 3% of NAV was valued a certain way, which the shoe fitted that it was relating to this asset. So I believe that's accurate at 12. So yesterday's news leaves us just with two sets of question marks. So what I've done here, okay, is I've put in the sale value. So that's the 48 million net at a $122 rate. Okay. And that works out at 4.5 pence. So that's kind of where we see our loss of value. So we see a realization of these assets, and what I've done is I've made what I think is the reasonable assumption of the Times article, which spoke of a potential sale at 45 million of Elio. So I'm going to go with that number, and then that just leaves one single number, which is the value of Arqiva. So from the looks of kind of deducing that the rest of the numbers look like this, Arqiva therefore looks like this, 396.7 million. Now, Arqiva, and I've written about this in an article where we looked at the June accounts. Now, Arqiva as a holding is very different to Aqua Comms or Elio in that they are due to bondholders and various reasons, that they actually publish a full set of accounts every year, and actually twice a year. So they do a 6 monthly for bondholders, for debt holders, and they do a once a year for everyone else. And I guess that's kind of connected into them being a sort of semi-public sector. They're not public sector, they're privately owned, but they're sort of public sector, I guess you could say. I'm pretty sure that one time they were a nationalized industry that got privatized. I don't know that for certain, but I think that's the case. Anyway, regardless of whether they are or they aren't, they publish accounts. So we do have a full set of accounts that we can consider, and these are them here. So you know what the June accounts kind of tell us is Yes, there was some margin pressure, and yes, there were some reductions to profitability. Um, but a lot of it was down to the power cost spike from 22, 23, that fed into costs, and also that Arqiva spent quite a bit of investment in renewing and improving equipment that reduce their energy usage. So that hit their profits, but those were investments into energy saving. And again, part of it is this whole ECG thing of, oh, we're lowering our carbon footprint, blah blah blah. So I think if we go and look at carbon reporting, it's mentioned 40 times, and you can see here, that it's progressing towards net zero and reducing energy consumption. So um, yeah, here we go. The carbon emissions report 62 to 63. So if we fast forward into 62, 63, yeah, so you can see that um, quite a bit of um, quite a bit of investments gone in, but that's also a positive in the sense that that reduces costs in future years. So yeah, if we look at the carbon report, so we can see, for example, gas consumption's down 0.38 of a gigawatt hour. That's quite a lot of energy use, to be fair. Uh, Actually, sorry, restated is 1.7 to 1.6, so not quite sure how they've managed to knock off zero point 0.2 of a gigawatt hour. That's quite a lot of discrepancy of energy there, but you could see as well, the fleet, presumably petrol consumption's down 10%, diesel generators down a whopping was that about 75%, 80%. So total scope one is down by about a third. So some pretty major energy saving going on in the year of 2024, year to June 2024. So when they say their operating profits are down, I mean, yes, the profits are down on the face of it, but um, this is not. How shall I say this? The fact that there's an implied 20% reduction on the net asset value, on the holding value from Digital 9, um, it's quite hard to justify 20% off. I kind of look at that and think, and that's not just me being biased. I just look at it and think, well, where are you arriving at 20%? Because um, what we see is revenue increasing. So overall, the um, media business is up by about 1.2, 1.3%. The media and broadcast business is up less. So, but I mean, um, this is radio broadcasting, television broadcasting. It's contractual delivery going out decades. It's a utility service with billions in order book value, and yes, more subscription services and looking at watching television over the internet, that is increasing. Um, but but Arqiva are very heavily involved in, for example, satellite delivery and different things. So it's not necessarily the case that a decline in television watching, which kind of isn't happening particularly quickly. At the end of the day, 75% continue to watch broadcast content each week. So 1 in 4 don't, 3 in 4 do, and then 9 out of 10 listen to over 20 hours of radio every week. I mean, I just find that bonkers because I probably don't even listen to two. But anyway, everyone's different, I guess. Anyway, so uh, yeah, so the media and broadcasting business is not really. declining in any great way. You've got inflation-linked contracts, so all of those energy price rises pretty much get passed on to customers as well. That's just part of the contractual pass through. And they've got a market share of sort of 99% of radio. I think it's 98.5 of public sector broadcasters. So that'll be Channel 5, BBC, etc. So they've also got 25 satellites delivering content to and then 80 uplink dishes at 5 heliports. So I think they serve 100 countries through satellite. So there's 300 key media and broadcast locations throughout the UK, with networks to 5 continents across the world, through leased access to a third-party global fibre network. Maybe that's Aqua Comms, who knows? Uh, and an order book of £2.4 billion. Contracts are RPI linked, and contracts run as far as 2035. So a significant proportion is RPI linked. So is that part of the business worth 20% this year? Suddenly, I don't see it. And then we've moved to the smart utility networks. Well, this is growing even faster. So few, in terms of water meters, fewer than 3 in 10 have a smart water meter. Sorry, smart water meter. I think energy meters, it's a bit more saturated. It's about 50%, and you've probably got the easy 50% that have smart meters, and now the holdouts are people who positively don't want a smart meter, and news stories are starting to circulate about how we're going to have 30-minute pricing, and you'll suddenly, rather than paying a flat rate for electricity, if you want to if you want to pay for electricity during the early evening, maybe you'll pay triple the price for the electricity. But if you put the telly on at 11 o'clock at night, or boil the kettle and have a cup of tea, then it'll cost you a third of the electricity price. So there's all sorts of stuff that's coming down the line around that. But anyway, uh, Arqiva have 5 million customers, and the bulk of the profit is very interesting. When I looked at the constituent companies within the Arqiva group, the actual smart meters business doesn't make a lot of money at all. It's not very profitable at all. But when they consolidate the accounts, it suddenly becomes a very profitable business. And I kind of was trying to work it out, and then it struck me that the reason that they make as much as they do in the consolidated accounts are dramatically different is the fact that Arqiva, of course, are a broadcast company, and they and one other operate the comms between the smart meters. Obviously, a smart meter is only smart in the sense that it tracks energy use or water use, and then it reports it back. So it reports it back is done by Arqiva and one other. There's two companies that have, and the bulk of the profitability is that activity, from looking at the Arqiva accounts, as far as I can tell anyway. So if penetration of smart meters is going to increase, that is actually a tailwind. That is actually a profit center for Arqiva, regardless of whether Arqiva itself is delivering the smart meter. Delivering the smart meter bit is actually the less profitable bit. However, Ofwat are looking to drive to double smart meters. So there's 5 million smart meter contracts up for grabs. There's a good chance that Arqiva will pick up. Arqiva is the dominant player in the water meter market. It's undisputed leader in the media side as well, but the leading smart utilities platform. And in fact, I did some research in an article where I compared. It was somebody that had said, "Oh yes, the U Group have this wonderful smart meter business that's growing fast." and I kind of looked at it. So I kind of looked at it, and this is what you can buy Digital 9 for. This is what you can buy U Group for. So when you actually look at the two businesses, so this is just taking the proportion of the smart meter. These guys deliver energy, so gas, electricity, services. And a reader told me that they're not just a broker, but they actually deliver the energy. So that appears to be the bulk of their profit, because you can see here overall they're making 42 million gross profit, of which smart meters deliver 1.88 of that 42.88, so 41 million versus sort of 2 million. Like, to me, that's not that exciting a business. And once you take out your costs, and what I've done here is that these were actually disclosed, whereas here what I've done is I've taken a pro rata to the revenue. So I've just said, look, this is roughly one third of the business, so I'm going to sort of take a pro rata approach. So you can see here, this 100 million of revenue of smart meter management delivers 18, so it's net profit 18% net profit, whereas here it's about 4% net profit. Sorry, net margin. Sorry, and that's not, sorry, when I say net margin, that's operating profit margin. So vastly more profitable, like four and a half times more profitable percentage wise, because of the comms. That's the only explanation. Because actually in the accounts, Arqiva say, well, this is not a very profitable business because of our third-party costs. So I mean, they're pretty much just, they're not making money on it because they're just subcontracting it. And the thing that makes the money is that they subcontract it and then deliver the comms to the subcontractor, which makes the profit. So that's pretty much it. And this bit here is basically, to buy Digital 9 gets you 51.75 of these numbers here. So taking sort of 51.75% of that profit there, basically for every £1 that you buy of Digital 9, you get 7.28 pence of operating profit, whereas £1 of U delivers you, well, sort of less than 0.1 of a pence of profit per pound. So it's sort of 7 in 10,000 versus 72 in 1,000. So it's 10,000 times different. So yeah, when someone said the smart meter business is very exciting, I'm like, is it? I mean, obviously, as a business, they are very successful, growing fast. Yeah, absolutely, don't dispute that. I can see why people want to invest in U Group, but is it smart meter business exciting? Not massively. Like, from a margin point of view, it's not. From a size point of view, it's not. I imagine that there's synergies between supplying the electricity and then supplying the meters, whereas Arqiva don't get involved in that. So they are different businesses. I completely accept the point that somebody else made, that they are very different businesses, but they overlap on the smart meters, and that's what I compared. And when I compared them, the Arqiva business just is miles better. I mean, it's just, the numbers are there. 4% versus 18.5%. I mean, come on. And the other perhaps way of looking at it was, I said, well, look, they've both got other businesses, so let's just compare the whole thing. I mean, again, they're not the same businesses, they're very different businesses. But again, let's kind of say, well, £1 spent on buying each of these, what do we get? Well, overall, again, I'm doing this on the latest 6-month figures here for U Group, and I've just taken, because you, I mean, whilst you do get the interims to the bondholders, it doesn't sort of give full disclosure. So I've taken the annual numbers for June 2024 and divided them by 2. So, again, you might sort of be unhappy with that and say, oh, but you've got to start somewhere with these things. So anyway, I took the revenue, took the cost of sales. So I mean, we see here that Arqiva is a much higher gross margin business, much higher gross margin business. Obviously has um, much higher overhead, so that's probably just how they slice and dice their costs. That kind of thing has much higher depreciation. Um, if they delivered energy, I find that quite hard to believe because come on, £1 million of depreciation. How can you be providing energy? So I think they are just a broker because otherwise they'd have a massive depreciation number. I mean, look, I haven't gone and looked at U Group and on how they deliver their other part outside their smart meters. But somebody who said to me, "Oh, well, they're not just a broker." Well, explain that depreciation number then. I mean, what do they have? Sort of energy assets that never depreciate? Come on. Anyway, yeah, so obviously depreciation's higher. So overall, I mean, again, similar revenue, similar-ish. I mean, similar-ish. The operating profit, excuse me, of the overall business is a lot higher for Arqiva than for you. Yeah, it's true that you is growing faster, so you're paying for growth. So you could argue it that way. And here I sort of said, they've gone from 40,000 meters to 72,000 meters, obviously versus 5 million meters. So yeah, there's a good growth there, and there's a good growth of revenue there, and good growth of EBITDA earnings there. So, yes, I can sort of see why somebody would say, well, look, it's lower profits today, but da-di-da, tomorrow it's going to be, yeah, I completely understand that. But, I mean, look at this, £1, and that's just taking 51% of that number there, because Digital 9 only own 51.75 economic interest. That delivers 45 pence of operating profit earnings versus 5.5. So even if your profits are growing faster, da-di-da-di-da, it's going to take a while for it to be as value, as good value as this. So, I mean, you're looking at 9 times difference, and obviously that's partly and mainly, predominantly actually, because you can buy Digital 9 so flipping cheaply. Um, yeah, anyway, I just thought it was interesting to kind of look at, we're talking about a business that's suddenly worth 20% less, but when you put it against something like which is, you know, has been tipped by many people. They're sort of part of people's 2025 best ideas, da da da. Great score on Stockopedia, that kind of thing. And this was interesting as well, that I sort of said, right, well, let's take the operating cash flow, take the capex, take the free cash flow, and then sort of, again, look at the price to free cash flow. Let's look at the and what I'm doing there 2 times is because again it's that 51.75%. So 51.75% of that in relation to that is 2 times. That in relation to that is 5 times. Now, it's true to say that is not heavily indebted and Arqiva does have more debt. So I then said, even though free cash flow is pre-finance costs, let's actually just strip out the finance costs to give it a fairer view of it. And to be fair, at this point, obviously, pulls ahead because free cash flow net of finance costs is 62 versus 51. So yeah, I mean, at this point you could say, oh, we'll use the better company because it can deliver more free cash flow to its shareholders. That's true. That's true. But there's quite a number of things I would point out that the if we go and look at the accounts, the the debt at Arqiva is pretty expensive. It is pretty high. And obviously interest rates have come down, and you'd like to think that they could refinance it at a lower rate. For contractual income that's and an order book of several billion, like could you not refinance that at 4-5%? I mean, if you did, then that comparison that I just did to interest costs would obviously completely tip back towards Arqiva. Completely tip back towards Arqiva. They're paying a lot of money to borrow money, and they are borrowing a lot of money. When I say borrowing a lot of money, the numbers are that they're borrowing about 2.2 billion. So there's a lot of, when you look at the accounts, there's a lot of shareholder loans, this kind of thing, that ultimately are shareholder loans to Digital9 and to the other shareholders. So really, you've got to strip out those to kind of get any sense of the numbers. And what you see is the debt. The debt is 2.29 billion, so obviously substantial, but it's backed by 3.2 billion of assets, and those are in the main part real assets. Their equipment, their land, their so there's you're not talking 3.2 billion of intangibles. It's all sort of very much backed by assets, and obviously at book value, where the book value, I mean, television mast locations will have been the same television mast locations. I mean, the high ground where things get beamed from. Not being funny, but you could probably go in a time machine 80 years back to World War II, and those same locations would be where they were kind of beaming television from after World War II, after the war. So if they bought the land 80 years ago and it's in the books at book value, I mean, that alone could just be, they could be sitting on billions of land value, and probably are, because the land was bought back when it was, 3 shillings and several farthings or something. I mean, so my point is that 3.2 is probably pretty solid. So again, show me where the 20% is in all of this, because 51.75% of the net the shareholder funds, which is 903 million, which increased by 50 million year to year, again stripping out the shareholder loans. Where's the minus 20% in any of that? I mean, the net assets grew, so even net of finance costs and everything else, the shareholders' equity grew year to year. So this, in fact, if we just kind of drag and drop that, so the value, the value as far as the balance sheet is concerned of Digital9's holding went from 442 million to 467 million year to year. So that's mid-June to mid-June, sorry, June 23 to June 24. So look, I've said it enough times. I find it very weird that we are where we are, where this is only this has been written down from 503 at the end of 2023 to question mark, which I'm inferring is 396.7, which, and it might be that this one is 55.4 still, and that makes this 200 million and makes that 386 million. So they've written it off by more than 20% maybe, but it's going to be sort of within about 10 million, I reckon, of these numbers are going to be within 10 million accuracy, and obviously the two of them add up to the 403. So look, we've lost 27 million is the net result of the last two RNSs. Okay, the effect of selling those assets, when we kind of have a look at them here, so and these assets are for sale, and we've told that there's potential for them to be sold in the near term. So this is Elio and Sea Edge. Anyway, when we get to this point, we get 107 million. So we've now got enough to cover the RCF and then some. Obviously, there's timing issues behind all of this as well. We also have the Vern earn-in. Okay, so and then we've got the value of these assets. So let's now assume these are sold. So by June, and by that time the debt has increased. I'm gonna just essentially that this gets paid off. So I'm not growing this particularly, but I'm assuming that this doesn't get touched until 6 months' time. So it's grown again, and now worth or now owing 192. Anyway, with these assets sold, the cash balance is now this. So what we see, and the way to maybe look at this is what we see is that if we take the value of current and future cash from all of these sales is 164.94 million, so 165 million, plus this earning, okay, plus yeah, sorry. So those are the assets. So the assets come to 220 minus the debts. Okay, that gets you to minus 26. So let me just move this down so you can see it. So I'm doing assets here and here minus liabilities here and here. Okay, so that's all of the debts. That gets you to minus 26. Oh, I can see don't know how to take away my screen thing. Let me do it like this. Sorry, it's just want you to see this if I can. Is that going to work? Oh yeah, my picture's hidden behind it. Anyway, well look, I'll put it here. So what we're doing is we're saying this cash minus this cash minus this cash plus this cash, which is the earning, that gets you to minus 26. So based on today's or Friday's close, which values the whole thing at 14.9p, values it at 129 million. Add in that 26 million net, okay, gets you to 155. So what you've got to ask yourself, I mean, at that discounted Arqiva price, you're basically buying Arqiva for 60% off. If you then say, well, this earning here is an extra 52.7 million upside, so that's another 6.1p potential if this earning isn't written off. And as I've said in a previous video, there's no evidence to show that that's happening, and hopefully we'll get some sensible update to know whether that is or isn't happening, because they are being kept in the loop by Ardian, by Vern. So yeah, that there's a chance that some or all of this 52.7 million could also be in the price. And then the final thing to say is, well, this, and I've obviously gone on and on about how I believe the 20% off for Arqiva is off. that it's worth, to my mind, it's worth at least its book value, if not a lot more. But let's just say it's worth its book value. If that's the case, then the discount, then stretches to 70%, and the sort of the upside you're looking at of so if we take the 467 and bearing in mind, of course, I mean, like the other way of looking at it is to say, well, we're talking of 467 as of last June, so this is June 2025. So by that point, I mean, is there extra money in the, obviously it's made a profit. Is there extra is its valuation increasing at all? I mean, because these are not assets that are declining or standing still. These are growing assets. So anyway, you're looking at the net result here is you're looking at, from what I can see, even after you apply some pretty, you apply their logic, you apply some pretty harsh valuations that you've got to essentially you're paying 155 million for what potentially is a 467 million asset, or 400 million if you're not feeling, if you just want to follow their assumptions. So the 15p seems pretty cheap, and I know I've said that before, and obviously, but I suppose the point of this video is to say, well, the reaction yesterday when it dropped by 25%, to me that doesn't look logical, because you're essentially just taking, you're discounting the value of Arqiva, which I guess it comes down to your perception of Arqiva. But there we go. Anyway, that's all from me. Hope you found that useful, and we'll see what happens next. But yeah, as I say, you know, um, the reader who said the margins were compressing was absolutely right. No two ways about that. I was working from what we were being told, which was a complete change of story in 4 months later. So there we go. Anyway, Oak Bloke saying cheerio.